Picking undervalued stocks is an everyday hustle for investors. Everyone wants to buy low and sell high to multiply their money. But like everyone, do you also find it hard to come across such undervalued stocks? Do you want more sure wins in your portfolio? This video is about making the process of picking undervalued stocks easier. The words of wisdom are already around since Warren Buffett started investing 70-80 years ago. All you need is for us to compile and simplify the concepts. Here we show you what undervaluation means, what value traps are, and what is the actual process to pick undervalued stocks. Like most concepts, the definition of undervaluation has also changed, and we'll update you with the latest knowledge on the subject. We are going to use fundamental analysis to make the best out of temporarily broken down stocks, and this technique is a low-risk, high-reward way of multiplying your money. So hit the like button and press subscribe for more, and let's get to picking undervalued stocks. Chapter 1. What is undervaluation? Picking undervalued stocks is the most foundational investment thesis for the value investing strategy. Buy low, sell high is the general mantra of investing, but no one is more careful about buying low than value investors. Big bulls like Warren Buffett or the late Rakesh Jhunjhunwala have been consistent in picking undervalued stocks. Buffett has picked undervalued stocks like Dairy Queen, Wells Fargo, and his holding company Berkshire Hathaway itself. Jhunjhunwala's undervalued pick stories of Titan, which became a 1,000-bagger for him, are everywhere to be heard. So what is meant by undervaluation? The first thing to learn, if you do not have the knowledge, is that price is not always representative of the stock value. The underlying value of a stock comes from its fundamentals. There is a business behind the stock tickers going red and green. Reliance Industries has been a listed company since 1977, and its stock price has seen ups and downs, but behind that stock price volatility, the company has transformed. It began as a textile mill and then diversified to an oil refinery, petrochemicals, and now it is the largest telecom and retail store operator in addition to other assets. Changing and growing a fundamental business has meant the stock is a multi-bagger through the years. Thus, undervalued means buying a stock when its price is below its fair or intrinsic value. Ben Graham, the guru of Buffett, has given the motto, "Price is what you pay, value is what you get." But why waste energy finding undervalued stocks? You might argue that, don't stocks usually just go up? First, stocks do not always go up. For example, the PSU power giant NTPC is currently trading at 170 rupees, but it has given just 170% returns in 18 years. In fact, an IPO investor would have been better off selling in 3 years when it hit its all-time high of 226 in Jan 2008. It has been 14 years and NTPC has never broken that price level. Apart from these stagnant stocks, there are also degrowers, which erode in value and eventually go bankrupt or delisted. Examples like Reliance Communications come to mind. Thus, buying at any price is unlikely to work as an investment strategy. The second thing is to achieve the target of buy low, sell high. The most certain way of making good CAGR returns is to create the maximum possible difference between the buy price and the selling. Undervalued stocks provide temporary opportunities for buying great companies at tanked prices due to some news or market factors. For example, during the news of the COVID pandemic, anyone with a rational outlook could have bought brilliant companies like HDFC Bank at a discount. According to Buffett, such times of pessimism are when good stocks are available for sale. The HDFC Bank stock has given about 100% from the bottom in 2 years. So the bottom line is, undervalued stocks are a low-risk, high-return way of making big in the stock market. However, there are some traps in value investing too. You must know to differentiate undervalued stocks from junk stocks. But before that, if you're liking this video so far, drop a like and press the subscribe button for more such content. Chapter 2. True Undervaluation and Traps. Now we make an entry into how undervaluation is measured. This is necessary to understand why people fall into what is known as a value trap and end up buying junk stocks instead of picking undervalued winners. The measurements are called multiples. The most basic one is the price to earnings multiple, or PE ratio in short. Multiples are parameters that relate price to the fundamental values of the business. For example, the PE ratio is a good measure to relate how much the company is earning against the price you invest. Think about it like this. There are two stocks. One trades at 20 PE and the other at 80 PE. If all other factors are the same, which stock should you invest in and why? If you have already applied valuations, go type down in the comment section which would you prefer, the 20 PE stock or the 80 PE one. Valuation-wise, the preferable one is 20 PE. Why? Always think in terms of rupees. A 20 PE stock will earn you 1 rupee for every 20 you invest, while an 80 PE stock will do the same when you invest 80 rupees. It should be a no-brainer to go for the 20 PE stock. However, the real world is not so simple. There are other multiples like price to book value, EV or EBITDA, and other measures to seek value. They may point in different directions. Then there are value traps. These are stocks that trade at low multiples but actually are not undervalued because of fundamental business problems or issues in your analysis. Remember NTPC? It trades at just 9.7 PE, but since it is a government-owned PSU, it'll not excite investors because of government control and lack of ambitious growth. Tata Power is also a power company like NTPC but trades at 27 PE because it has large ambitions of expansion with good past growth. Therefore, current PE shows the past, but further analysis is needed to gauge the future. You also need more context of fundamentals to estimate intrinsic value. Just buying low PE stocks will not ensure returns. So how do you even begin to account for these complexities? The answer lies in evolving a process. Chapter 3: The process of picking undervalued stocks. The first thing is to go decide what type of returns you want and which business sectors you have a good understanding of. Someone who does not know how drugs are processed and how they are regulated should not straightaway invest in pharma stocks after Googling top pharma stocks. You will need to understand the sector and how the company fits into it. So there are tools called screeners that can narrow your searches. Ticker Tape is a good free tool for this. You can set market value, price, and valuation metrics like PE. Add fundamentals to the mix like 5-year average growth and profitability and debt metrics so that you can get a broader picture. The screener will give you the names of the stocks with relevant values you searched for. Now you can choose 5 to 10 stocks from these to get a good universe to analyze. Stocks chosen from your circle of competence are better suited. The circle of competence means the knowledge about various types of businesses you possess. Remember the pharma sector example for this. Then you can dive deep. Go to the company website and social media to get a real feel. Download its annual reports and investor presentations to see what it has done in the past and what the stock is planning to do in the future. All this fundamental analysis will help you justify the PE ratio and forward PE ratio based on expected growth. This is a detailed procedure to pick undervalued stocks. You can never be too careful in the stock market, as it is important to ascertain that the stock is truly undervalued and not on a path to becoming junk. There is also a path further than this. You still have to act on the information you gained to actually make the returns. One of the things to remember is to keep a margin of safety. Similar to how you leave early to catch a flight, you should keep some buffer for errors in investments as well. Graham is given intrinsic value is equal to earnings per share multiplied by 8.5 added to twice the expected annual growth rate formula. But you must not invest at a price that is not significantly far from the intrinsic value. For example, the average growth rate for HDFC Bank is around 18%. By this formula, its intrinsic value will be about 2970 rupees at an EPS of 66.8 rupees for 2022. The current price is 1630, which indicates a 45% undervalued nature. So an investor is safe buying such investment, trading way below its fair price. The second thing is to have an investment outlook or horizon. This is the question: how long are you intending to hold? You see, some stocks are consistent compounders and can be held forever, while others might just be temporarily undervalued and can return to fair value in a year or two. Our example of HDFC Bank can fit into both these scenarios. The stock has been a long-term compounder, but could have also been in the 2020 COVID pandemic to make quick returns. On the other hand, the NTPC example can only fit the second strategy. We already know that neither the stock nor the business is a consistent compounder, or at least the growth is very low to register. Instead, it would have also returned over 100% returns from the 2020 pandemic, as fundamentally nothing changed for NTPC in the period. People were still going to buy electricity in the future, so you'll have to choose for yourself. This brings us to the conclusion of this video. Let's summarize what we have learned here. Undervaluation is a phenomenon when the price of a stock is lower than its intrinsic value, which reflects the business fundamentals. Price multiples like PE are basic indicators of undervaluation, but deeper research on the industry and the particular company is needed to stay away from value traps and ascertain its true nature. Lastly, the use of tools like a stock screener can narrow your research, and you can choose a few stocks to perform a deeper analysis on. Arriving at a fair value number and keeping a good margin of safety will make the bet worthwhile in terms of profitable returns and lowering the risk you're taking. Always remember, pick undervalued stocks and invest how it suits you, not Buffett or Jhunjhunwala. So what type of investment do you like? A compounder like HDFC Bank or a temporary undervaluation like NTPC? Go type down in the comments below. Press the like button if you haven't already and subscribe to the channel for more such content. Do you want to know more about how money works and want to maximize your investment returns? Then visit this video on the Psychology of Money book summary.